Okay, GM, welcome back to another episode. We made it a month, so congratulations. Thanks for joining me on another chat about topical financial matters. I thought we'd do like a two-topic chat today, sort of get away from some of the more AI stuff that we've been talking about and some of the current developments and talk about some topical stonks. Um, probably first, there hasn't been a whole lot of news out on the whole credit scoring complex this week, but Eisman did this a chat with Kelsey Zhu, who covers most of the companies in the financial, like regulatory capture, financial uh, scoring, mortgage complex, whatever. And it's actually it was a very good if you're not really up to speed on how a lot of the things have been developing over the last couple of years with consumer credit scores and how they cross over into um, the conforming mortgage market. It's quite good background. Um, like it's 71 minutes or something like that, and three-quarters of it is devoted to FICO and their outrageous, insert your number percent price increases. Um, my quick take on it is that there's quite a few there are a few holes in the analysis, especially in as far as it goes, with respect to implications of the history. So, like, um, like where to begin? I think a lot of this stuff it's kind of up in the air anyway, so it's a bit hard to come down with like a very hard and fast, answer to a lot of these things. But it does seem that people continue to get foundational, facts just wrong, especially with FICO's relationship to the credit bureaus, and certainly FICO's relationship with other counterparties in the conforming market. So people just like this isn't really helped by the fact that probably the FHFA director doesn't really know either. The credit bureau CEOs who and their representatives are also incentivized to lie. Maybe not lie, but at least present facts in a pretty misleading way. And then FICO is also like very tight-lipped, and they again, it's probably been to their detriment in the last couple of years. Certainly, the fact that they are not located like close to the regulator. They're out in Bozeman, Montana. Part of their office works out of like a co-working space. Um, it's and there's a lot of assertions being made. Many of them aren't really. There's not a whole lot of public factual information to back them up. So it's really tough, and the credit bureaus are very promotional, and so is the CEO of Vantage Score. And yeah, no one really is like made to account for some of the claims they make, which is I mean, it's a free market, and you can kind of do what you want to do, but um, within the realms of the law. But in in the most part, I think a lot of these characteristics will be proven out in the fullness of time. Like I said, with the 71 minutes of chat here, basically it boils down to the sell side sees no market share loss in the conforming market for FICO for the next 3 or 4 years. The Kelsey Zhu, the analyst, she kind of sees 40% market share loss by 2029, 2030. in the conforming market, and Steve Eisman here, he's short the shares. And basically, his his contention is that when the market realizes that FICO is no longer a monopoly, that it'll like completely lose a bid. So they'll whatever the trailing multiple is now, that could just go to like 10 times, 5 times, something like that. And he's just kind of like waiting for the other shoe to drop. My like quick take on this would be that that was like a very compelling thesis 18 months ago. So I would say it's a far less compelling thesis now, just because it looks like the kind of you know I would have also said this 6 months ago, but it appears like the chamber is kind of like empty in terms of like other developments that that could occur. Um, so yeah, look, like basically this whole story, this like even the whole controversy about the price increases, blah blah blah. Even this background is not very well like basically understood. If you were to kind of like ask the know nothing observer, it would just be that FICO has pissed off the entire lending landscape because they raised their prices a lot between 2018 and well, as of today. The price of a hard pull in mortgage went from 60 cents to $10, or maybe $4.95, and the $33 performance fee, or perhaps $1 up front and $63 on the back end, blah blah. And because they raise these prices so much, it's kind of like upset everyone, etc. And their monopoly is now over because there's um there's there's imminent competition coming for the conforming market. So it's kind of like a very low IQ take. Probably you could also wrap this in with with the idea that the price increases induced this change by the regulator. Um, it's like a very spurious causal link. In my mind, it really doesn't take into account plenty of the other actors that have kind of been playing along with this. So, like the high level narrative for this whole thing is that in 2018 there was a credit consumer reform passed under the Trump administration, thereafter signed that into law. This was in conjunction with and or kicked off a credit scoring review by the FHFA, which is the regulator of Fannie and Freddie, amongst a few other bodies. Fannie and Freddie. Okay, so this review roughly kicked off in the late 2010s, and which was resolved in 2022 under the then Biden administration. There was a lot of information even in this review process, which has only come to light in the last couple of years, which was reviewed. It came to light in a freedom of information request that was made of the GSEs, which was highly redacted when it was released last year. Basically, there was a lot of conflict between the GSEs, so Fannie and Freddie, and between the FHFA. The FHFA, which is directed by the administration for the most part, has political uh, motivations for their policy decisions, and the GSEs have um, internal preferences that are, about convenience and efficiency and making things, as operationally streamlined as possible. So there's often conflict between the two. Unfortunately, the GSE's conservatorship gives the FHFA nearly unilateral ability to direct the GSEs in their in their operation. So that basically, the GSEs can do their own reviews, make their own requests, etc. At the end of the day, the FHFA director can simply just tell them what they're going to do. 2022, this the first review was released along with its finding, which was basically it came to the it again, the idea was to promote competition in what is a very um, sturgy, old school, credit reporting and credit scoring ecosystem. But basically, you've got the tri-merge credit report, which is a credit report from all three of the credit bureaus. For a conforming mortgage, you need to pull one of those from each of the three credit bureaus, and then historically, you'd run one FICO score, FICO Classic, on each of those. And there's parts where the score and the credit file are used in prequal, and then how many times they're pulled during the application, and et cetera, and on and on. Basically, the regulator came out and said, okay, we're going to go to uh, basically, dual um, by merge basically for the credit file, which means you pull two credit file reports instead of three, hence competition. And for each of those credit reports that you pull, you'll pull one Vantage score and one FICO score. Now that was actually a pretty good compromise for almost everyone involved. The loss of a credit file, or the introduction of competition for the credit file, that has implications in terms of pricing and then product development. So if you're only going to pick two, the borrower, the lender or the originator, they have a lot more leverage in that case about which two they're going to pull. And now, obviously, there'll probably be some pricing equilibrium that would be, eventually reached with each of the bureaus who don't want to cut each other's grass. So they might defend pricing, but at the same time, they're going to lose a third of their vols, all things being equal. However, they also all each own Vantage Score. Their commercial agreement with Vantage Score is that for each Vantage Score that a credit bureau originates, they collect that revenue minus a little bit that's remitted back to Vantage Score. So not only do they each own a third of it, they're basically worth the credit score that they originate in each case. So you know the quid pro quo was that okay, we'll have competition at the credit file level, but to make up for that, we'll include this other score. So you've got to pull this other score along with a FICO score, and you just price it at like you could price that credit score at the FICO score level, below it, above it. It didn't matter because you had to pull it. So kind of everyone was pretty happy with this. FICO took a lot of price in mortgage in anticipation that buy merge would eventually be rolled out. Now, buy merge required the originators and the lenders and everyone else to develop new infrastructure, new processes, etc. Blah blah. How you going to incorporate Vantage into the whole underwriting process, modeling, etc., etc., etc. On and on it goes. And buy merge was basically resisted by the whole um, by the whole ecosystem at large. So the originators, again, the ones who are kind of would benefit from this, at least from a pricing level, resisted it tooth and nail, especially the smaller ones who don't have, they're just interested in originating loans and selling them. That's their business. Their business is not to like hyper optimize the origination process. These people just, basically just dragged their feet. They didn't do it. The industry bodies started lobbying the government for extended timelines. And ultimately, when the second Trump administration took office, they just shelved buy merge altogether. They said, we're freezing it. We'll review this. And then it's kind of been on ice ever since. So really, since Trump, signed the original reform in 2018, and then after the GSEs review, sorry, the GSEs and the FHFA reviewed the whole thing, I mean, nothing's changed. There's been a lot of directives given by the FHFA. There's been a lot of industry lobbying. There's been, this, that, the other controversy, left, right, and center. And even today, with all the things that's happened in the last year, in fact, so the process that is being run today for originated conforming loans is no different than it was in 2018, including the score available the score that's being implemented. So, there's all this talk about FICO 10T being released and when Vantage Score 4.0 is going to be released, et cetera, et cetera, et cetera. You go on and on. You pick whichever dictate you want out of the last 6 years. Nothing has changed. Nothing has changed. So that's the fact. That's not the de jure answer. That's not the in law, what's been mandated answer. But realistically speaking, if you originate a conforming loan today that will be accepted by the GSEs and then bought by investors in the secondary market, there's been no change. That whole process is the same right today. It's the exact same. Again, so this the buy merge transition again resisted tooth and nail even by the people who wanted it or who said they wanted it. So it never got off the ground, it never got implemented, and the Trump administration shelled it. The dual scoring part of this was also shelved. Dual scoring would have been a great outcome for um for FICO. It would be maybe not completely irrelevant, but it's kind of like a neither here nor there. It doesn't really matter to them if another score gets pulled with their score because whatever, their score is still getting pulled. Um, for the credit bureaus, it's huge margin. When they originate one of these scores, again, the economics is very good. It's just an algo that runs on top of their own data, and so they were looking at a lot of incremental margin coming in. It also didn't affect the wider ecosystem. So in terms of this is and this point I'm about to make is something else which is also not very well understood um, by pretty much everyone, including people who kind of like have covered the industry for a number of years, is that you can think about the score as like a rail. It's a communication rail that goes all the way from originator to investor. And through the originator, they go through the credit bureaus and the services and the tri-merge resellers and the GSEs and the commercial banks that securitize the loans and the investors that buy the loans, and the infrastructure and technology providers, and the what people who warehouse the loan, banks that end up warehousing the loans, et cetera, et cetera, et cetera. It is a communication rail through that whole process. There is a misconception that the score matters because it is predictive, or it is the most it's the most accurate way to price performance. That is not true. That hasn't been true for decades. In fact, this is also not well known, but the GSEs and heaps of underwriters, they might have used the FICO score 50 years ago, 30 years ago, whatever, as a kind of innovative solution to price the credit worthiness of a borrower. But they don't do that today. Most commercial banks, most originators, the GSEs themselves, you name it, even the investors, all these people, they are using their own proprietary models to assess credit performance. Now, the FICO score is a part of that because if you use a proprietary scoring, underwriting model, by its nature, it is proprietary. For you to communicate the creditworthiness to someone else is by definition impossible. You can't do it. So what multiple parties need when they are all underwriting creditworthiness is they need a common standard, a common language, something that can easily transfer what they know and how they've underwritten something to someone else. That's why there's historically just been one of these. Not because, because FICO is the most predictive. In fact, I've read several expert transcripts which basically say that the score, is between 15 and 24 parameters. So basically, you could go down to your whatever closest university library is, pull out a statistics book, calculus. I don't know what I wasn't good at maths, but using university slash high school level mathematics, you could create a score of similar predictiveness. Now you'd miss out on, all the feedback and all the credit reporting that you've done, but you could probably come to something, not too dissimilar. Um, than what FICO Classic is. And in fact, it would be pretty easy to back into it, especially if you could buy some long-term data sets off people. But to digress, this is it's not an accuracy thing. It's an accuracy between counterparties type thing. In a world where you had like one bank that originated all its own loans, and then it securitized its own loans, and then it bought its own loans, and then it guaranteed its own loans, insured its own loans, blah blah. Like, yes, in that case there would just be one proprietary model that one bank would use, and there wouldn't be, you wouldn't it could be a lot more complex, but you need a simple communication language that can be, run through, that multiple different parties can understand. And then there are efficiency gains because of that. And so this model where you'd pull two scores would be fine because you could just keep running all the credits through the same communication rail. Like, yeah, okay, this thing has a Vantage score on top of it, cool. But we know what the FICO score thing is, so no problems. Pass it through. I'm going to know how to price that. That fits into my models, et cetera, et cetera, et cetera. The existing infrastructure would not have to be changed. A good outcome, a pretty good outcome, and also I would add a very good outcome for Vantage score itself, and the credit bureaus by extension, simply because this would be a way that people could adopt their score en masse, and then it could over time, separate infrastructure could be built up to support the Vantage part of it. And you would do that at very little cost, and you could do it incrementally over time. And so the acceptance would probably take quite a number of years to get it all lined out. But you would have got yourself in there, like arthritis. You're in there, and you can spread throughout the system over years, and in a very similar fashion to what FICO started to do 32 years ago. However, again, that whole compromise was thrown out by the Trump administration, and this is again not very well known, but the credit bureaus, possibly in hand with some very persuasive industry lobbying bodies, especially the Mortgage Brokers Association, the Mortgage Bankers Association, the MBA. They were very influential with the Trump administration. They were influential with the Trump administration in the first administration, and no less so in the second, perhaps even more. And they certainly had the ear of the FHFA director. Now, Bill Pulte, the FHFA director, mercurial, likes to make big sweeping decisions, wants to get stuff done. He's he's got a very Trumpian streak to him, and that's his personality. So he sort of, when the Trump administration came in at large throughout the administration, many things were put on ice. So if you were in the middle of implementing a Biden era policy, that policy was stopped immediately. And then, oh, by the way, if you're a high level executive at most of these executive agencies, you're also out of a job that afternoon. Which was that story happened in a lot of departments in the federal bureaucracy, and the FHFA was no different. So, Pulte came in, he fired basically the entire executive suite of both the FHFA and the GSEs. He installed himself as the chief executive in all of these at the GSEs, which is not sure on the legality of that, but no one's gonna stop the guys. And then they started, almost having, dictatorial power would be an overstatement, simply because a lot of these policies, as they pertain to the conforming market, they have to be implemented by people, which is what which is what the Trump administration is finding out now, is that making a whole bunch of policy and administrative decisions is fine, but you actually need the cooperation of the people in these bodies to comply with some of these things. So they put bi-merge and mandatory dual scoring on ice, came in, 3 or 4 months later, under what appeared to be some pretty heavy lobbying from the Mortgage Bankers Association, the MBA, and likely the the credit bureaus, although you could probably be a little bit sus on their influence just because of how incompetent their management is. That's where lender's choice came from. So the a influential number of community bank and small bank lenders were upset with some of these price increases that had been pushed through in the kind of heavily recessive mortgage origination environment that has plagued the market since at least 2022 and 2023. They were finding it more and more difficult to defend their own business margins as the number of the gross number of mortgage applications declined, but then also the number that was being approved was declining at the same time. So when these sort of things go into reverse, a lot of the closing costs that a originator or a lender would put to the borrower at the end of a successful mortgage application, that wasn't happening, and some of these costs were being put back on them. And obviously, if your scoring costs have gone from 60 cents to $4, and you're pulling a score in prequal, and you're pulling 5, 6, 7, 8, 10 plus scores during a couple's mortgage application. These scores all add up, and a lot of these smaller lenders, to remain competitive with commercial banks and significant lenders, they, how can they be competitive? It's to say, hey, look, come in and apply with us. It's all, your application's going to be free, and in the event that you get a confirmed mortgage, that's when you'll pay. And so, this whole dynamic goes into reverse. They're very upset, despite the fact that the FICO score is a very small, probably the smallest single itemized component of the closing costs of a, of a of a conforming mortgage. The credit file for the longest time was, like a tri-merge credit report. That's historically, 3 times as much as what the score cost would be. A couple of years ago, even more. And even the credit file is a very small portion compared to things like title insurance, flood insurance, fire insurance. There can be HOA fees. On and on it goes. Typical $500,000 house might experience, 6 to 12 thousand dollars worth of closing costs, and a tri-merged credit score from FICO might, in last year it would have put you back like $15. That's not even 1% of the closing costs. It's such a small amount of the overall house costs that it's not even a rounding error. And something like title insurance, which is a complete racket, might be $1,500 or something like that, and is 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 having this efficient communication mechanism, that allows you to have this 30-year fixed rate. Like, is that worth 15? And title insurance, which is a localized monopoly, which kind of AI should have nuked this business by now, but it persists. Is that worth 100 times that amount? A lot of questions about this, but the title insurers are politically quite sensitive, so they don't get touched. The credit bureaus as well, they've sort of run out unscathed through all of this, and this quote unquote monopoly out in Bozeman, Montana, with no direct lobbying influence, and just trying to remain under the radar. They sort of become a convenient scapegoat, especially when the Trump administration has, kind of been underwhelming in its ability to provide lower interest costs for the American borrower. And so that is more of the story. I mean, to even put another flavor on this is that up until basically the direct licensing model was rolled out last year, the credit bureaus would all apply a 100% markup to the score. So the score runs through the credit bureaus. So the credit bureaus pull a score from FICO. Those credit reports are pulled by a tri-merge credit report reseller whose customer is the originator or the lender. And so, there's a lot of markups across this, but whatever percent price increase that you want to, put onto FICO, and there's no doubt about it, right? Depending on your relationship with them and depending on which credit report reseller you go through and etc. Like it's 1,000+% at this point in the last 8 years. There's no doubt about that. But you probably have to, if FICO are culpable for that, then the credit bureaus are at least as culpable. Not necessarily from credit file pricing, but because they were just marking up the score 100%. So however much price FICO took, the credit bureaus were riding along right with it, and that whole setup was also very cozy for them. That's 100%. If it's $5 for the score and $5 for me, that's $10 of revenue. My gross margin is 5. I collect $5 of pure profit on that, and I don't have to do a lot for it. Not only that, in the event that it all goes pear-shaped, I get to blame the score for it, despite the fact that I am participating in the exact same proportion that the score does. And you don't even hear people talk about things like the credit report resellers. They have a markup. You don't talk about the fact that most lenders, they will do something like charge $250 to $300 upfront for a whole bunch of these scoring and credit file related prices. They'll just hit the borrower up for that straight away, and even they get a margin out of it. So like literally everyone is in on the take here, and this populist impulse that's come from the right. There's FICO's been a very convenient scapegoat in all of this, and there's and on the other side, there's like a tremendous amount of um, you know, basically going to be turmoil. So even at this point, probably one of the things that I would disagree uh, with Eisman and Kelsey Zhu, who he interviewed, was, I think they're basically under the assumption that Vantage Score had been released, and to the best of my knowledge, that's not true. The the credit bureaus would agree, and so would FICO. So it hasn't technically been released yet. Like you can't go and run this stuff. They're still in a pilot phase. The large borrowers are apparently participating in this pilot of Vantage Score 4.0, but they don't even know they're participating in it. But the issue that they're running into at the moment is obviously the adverse selection issue, where even if there's slight variations in two different scores, it can, you will just pick the most advantageous score for the borrower, and then the quality of that paper degrades the loan pool over time. And there's all kinds of things in here where if the GSEs can just unilaterally put paper back to the originator and the lender. So if you have a very bad performing loan pools, they just end up getting put back with the person who's who sold it to the GSEs. So there's like all kinds of implications here for how this is going to run. There are differentials in the two scores. Again, this is a reason why there's typically one, because it's just more efficient for everyone to use the same communication language. If you're going to start using multiple communication languages, it would work if they were both virtually the same. But again, Vantage Score, since 2006-7, when it was created, it's been sold on the fact that it is different and more inclusive. It's going to include more people in the loan pool. And this is, again, another thematic that is not well understood. And we are primarily talking about the conforming market here. I won't even talk about the non-conforming market and things like auto and P loan and blah, blah, all this other stuff. We're talking about one very specific market. The conforming market, so a Fannie and Freddie loan, which is 30-year fixed rate. This whole market only exists to serve like the best credits: prime, near prime, ultra prime. for the most part. This market does not exist to support people who even might be a little suspect of not repaying. The only reason it works is because you're only approving the most pristine credits. It's the only way it can work. Um, at the interest rates that they give. And so, like the bottom line with a 30-year fixed rate mortgage is that it's a bad product to write. If someone's going to lend you money for 3 decades at the same interest rate and you're able to fully prepay it and then roll it, and refinance it at any time in that 30 years, that's a very bad proposition for you as the person lending, a terrible one. I wouldn't want to do that. But lending long term at fixed rates and it's prepayable. You're basically giving all the optionality to your counterparty. You're saying, interest rates are going to be lower in 30 years. You're not going to repay to refinance. And in the event that interest rates go up, I'm stuck at this rate. Like, my NIM on this loan is going to, be crushed. And over 30 years, anything can happen. Um, so it's a great product for the borrower. And so how do you make this work? You make this work because you have the reserve currency. You can borrow at structurally lower rates from the rest of the world and your own public. And then you can use that cheap money to guarantee these loans. And then you just lend it to the absolute most qualified borrowers. And so you have pristine credits, you have the lowest interest rate, the borrowing costs in the world. Uncle Sam underwrites it, and that's how this works. And so the whole idea that you would have more inclusive lending parameters in this very precarious product that's being underwritten by the American taxpayer is ridiculous. Um, even if you could make the argument that you're going to more accurately uh, price credits, which is, again, the banks, the GSEs, everyone in the ecosystem has already been doing this. They constantly update the models, right? They are banks. Of course, they're going to want to more accurately underwrite credits over time. This is not a sleepy thing that people are just using the same credit underwriting model than they were 50 years ago. That's preposterous. And so the fact that you're going to, basically, you know, uh, you know, exclude certain things that have historically correlated well with loan performance, and then include other things which haven't been, that well. I mean, the Vantage Score talks about including things like your utility bill, your rental history, all these kind of things. Um, you know, you're adding a lot of risk to the system, and these risks over time will just be they will be you know they will manifest in that they'll manifest somewhere. And so perhaps it's guarantee fees, the fees that the GSEs charge a borrower to guarantee the loan. Those have been structurally been going up over time. And if all things being equal, there's a lot of variation at the low end of the loan pool, perhaps those fees go up. Perhaps perhaps investors insist on a higher interest rate for for these, this new scoring rail that's being encouraged. Perhaps that's where it manifests. Um, perhaps it manifests in some of these community banks and smaller lenders going bankrupt because the GSEs have put back a ton of bad debts to them, that they've used because they've kind of like gamed the lending parameters and picked, whichever score was more advantageous. Ostensibly, in a very large portion of the case, that will be Vantage Score, because that's their whole rationale. And so there's a whole lot of ways this comes back, but it's very much a chicken and egg problem, in that there's already a solution to communicate between multiple parties, and having a second one does not create any more efficiencies, even though ostensibly pulling one score might be cheaper than the other one up front. And again, in the majority of cases, even in a bad year, it's something like, 50% of the, well, there's been varying numbers about how many loan applications are actually approved. Some sources say 50%, some say 15. I've seen others say 35, whatever. in many cases, the loans are being approved, and that cost is being pushed on, and then it's only the small number of community banks which have to compete vigorously for new business, where they might be uh, incurring these costs up front. But again, that this is not this is only the first part of the consideration. If you have some of these community banks which are structurally pulling, structurally selecting the worst bottom end credits of the loan pool, who's to say that those same originators and lenders they're gonna be stuck with all this poorly performing loans that they've originated because they wanted to save $4 up front, or whatever, $9, blah blah, you name it. Um, so and again, many of these things were sort of missed. These arguments were sort of missed by Eisman, and basically, I get the feeling the Vantage score. The people who are very bullish on Vantage score, especially over the next 5 years, they are over-indexing conversations that they've had with originators, and conversations, just conversations. People say all sorts of things in different moods and at different times and under different contexts. We have very little information about how people will actually act. When um, how they're actually going to respond to these incentives, and especially when we have so much evidence in the past that the industry as a whole, so again, not just one subsegment of one party to one of these things, is upset about something. There are multiple parties that all need to get on the same page, and for the most part, they are not changing their processes. These processes, which are tenuous to begin with in the first place. So, assuming there's going to be the market's going to basically devolve into like a 50-50, a market share in the next 5 years. I'm skeptical of that. I don't think there's like much, evidence to really support that kind of thing at all. I mean, that kind of dynamic exists in the credit reporting agencies, excuse me, the credit ratings agencies, under a mandate of mandatory dual scoring. So, there might be a market for rating corporate credit, but the regulatory environment mandates, and all kinds of other parties require you to have two scores. So two sets of ratings. But again, the ratings are not a communication language. The ratings are a standard. And so, in lieu of, mandatory dual scoring as opposed to rating, sorry, scoring in the consumer market, it's probably there are efficiencies to use one, and those efficiencies aren't measured in like $5 or $10. They're probably, they're measured in basis points. And the optionality of a 30-year mortgage, what's that worth to someone? $5,000, $10,000, depending on how big the score is. Then you have, this inertia. So, and you can even just roll this out to the other serious hard pull markets. Again, the hard pulls differ from soft pulls, and that hard pulls are credit scores that have been pulled for a securitized loan. So a situation where the lender or the originator is not the person who ends up warehousing the loan. They get securitized and they're sold to investors. The status quo outside of the conforming market in the securitized consumer lending space is the vast majority of those scores are FICO scores. That would certainly be the case in the non-conforming market, where this is a instance where a bank will warehouse the loan, so they are holding it on their own books. That's a situation with actually fewer parties, because the GSEs aren't involved, and typically investors aren't involved either. So, why does FICO have an enormous share of that market? That's quite interesting when there's less people involved. Auto, the majority of auto loans are scored using a FICO score. It's probably not the same level of of absolute pricing power there, just because again, the more parties that are involved, the more complexity that's involved, the more that the more valuable that atomic network is. And so you just kind of go down the line, as you move more and more into like less consequential scoring markets like fintech or whatever. As you get further and further down, the score becomes less and less valuable because there's less and less parties, and because again, many of these loans end up being warehoused by the people originating them because they suck. Just the credit quality of these suck. But to equate something like fintech, uh, loans being originated by fintechs and then largely held on their own balance sheets, to equate that kind of loan to a conforming mortgage is hysterical. On one side, a conforming mortgage loan, is essentially agency paper. This is like as close you can get to sovereign U.S. paper, outside of actual U.S. sovereign paper. And then so that's on one end of the extreme, and then fintech is like some of the crappiest, payday lending type loans that are out there. And so, that would be another critique I have of Kelsey's read of events, is that these lending verticals are not the same, and you can't equate very poor, your very mediocre loan pools with the conforming market. And I wouldn't even say you could compare it with the non-conforming market. Probably can't even compare it with automotive loans, etc. And at least automotive loans for the most part are secured against a physical asset, which which can be redeemed if people need a car to get to their work so that they can make money. Have these other things. If you're taking just like a consumer payday loan off a fintech, not equivalent. Um, and so these are like some of these foundational issues, and my like biggest conspiracy theory, which you can read about all on the blog if you like. I'll put the links below. I write about this all the time just because there's so much interesting stuff happening with it. But you know, uh, yeah, it's my biggest conspiracy theory is that the is that Vantage Score might never get released, simply because Pulte is he's at his point of maximum leverage before Vantage gets released. He's got the credit bureaus in his pocket. FICO is nervous. Lots of other people are, nervous as well about Pandora's box being opened. And then the minute that he releases it, all his leverage is gone. Um, who knows what FICO will do? Who knows what the credit bureaus will do with Vantage Score pricing? And these adverse selection issues, which are going to affect the ecosystem to some degree. It's arguable to what degree, but they are going to affect it at least initially. And he's going to be responsible for all of that. And I think they're obviously having big problems translating, scores. Is a 710 FICO score the equivalent of a 650? There's very large dispersions, and even large dispersions depending on like what day of the week it is or what time of the month it is. And once these things become available, all these, I'm not saying there's not upsides. I'm not saying there's not positive things about this. I'm not saying it's impossible. I'm just saying there are many risks that will, at the moment of release, become apparent. You're dealing with them that day. And then you have real world consequences for that. You have consequences for G fees, for interest rates, um, some of the other scenarios that I mentioned. And, in recent weeks, there's been a lot more of these interviews being done with, big lenders, big originators who are even starting to talk back some of this stuff themselves. I think, that maybe, like one way to interpret this is that a lot of these people were simply making a play to try and have FICO reduce the royalty. And then, FICO kind of decided to try and put as much of the royalty costs onto the actual consumer explicitly at the point that the mortgage gets confirmed, rather than have it being fronted by the lender. And so it appears that they've kind of went in that direction, and a lot of these guys were kind of like blowing a lot of smoke to see if they could make this happen or to see what they could get away with, and they've like kind of come to the precipice, and it looks like they've got as much as they're going to get, and they all seem to be like quietly walking back a lot of the very promotional stuff they were saying in recent years. And it's been very interesting, at least to me, to see. Obviously, I own FICO shares. I was also a Equifax holder for a time. Um, in more recent periods, I've been a bit discouraged at their expense management. Um, their international operation is a lark, and the way in which they have played out this whole scenario with both the regulator and FICO and the lenders, etc., has been pretty bad. And they've sort of misled a lot of people in terms of their culpability with the increase in scoring costs. And now they've just decided to put their price increases onto the credit file specifically. So they're kind of they're really hurting. If you think anyone's really hurting the consumer here, it's these guys. Um, and they're sort of underwhelming the way they've played this, and I think their shares have suffered in the short term. I think Equifax, as opposed to TransUnion and Experian, is quite well placed simply because of its Equifax. It's Equifax Workforce Solutions, or the Work Number business, which is a great business, one of the great businesses, I would argue. We might talk about that one in a separate video, but they've really caught the brunt of a lot of this disruption at the federal government. And I suspect that's not a long-term trend, that will have less welfare spending over time. Certainly is not the explicit policy of the United States, this United States government, the Trump administration. But these interest rate shocks that came along with the Iranian war and so on, they've just kind of put a real dampener on some of this de novo verification activity, which is what the Work Number does. It verifies income, which is usually the very starting point of any borrowing decision. Verify income to begin with, and it's a complete monopoly. It has great incentives with the people that supply it. Credit file, employment files, and they are able to branch this out into other areas, and their government business in terms of making reducing welfare fraud. That's even for the left wing governments, things like that are going to be very attractive. But again, it's kind of stuck in there with this whole credit file business, which looks so precariously placed right now. So precariously placed. One of the ways that Pulte could kind of distract people from this, maybe like, a lot of turmoil that's going to happen in the conforming market if he releases. Again, he might not. And then even if it does get released, it might just not get adoption or anything. But the way that he can kind of distract from that is to then go after the credit file and say, we're going to need, a bunch of credit file, we've reformed pricing and credit scoring. Let's go, we're going to go after the credit file now. And, the reform to the credit file was, part of the original reform. And so the bureaus they are, in essence, very exposed to that. There's talk of like pulling one credit file, so there's a big pricing question here, there's a huge volume question here. This is at the same time that they're also their investments never seem to kind of pan off, and so on. It just violates so many buyback principles. So anyways, we'll I'm not sure there was any much new information or any kind of breakthrough in terms of analysis here. It felt a little bit lazy on his part, but he's a he's a short seller, and you got to run a short book, and sentiment is obviously horrible across some of these names, and I assume he's made some nice money so far. So good luck to him. I think the analysis was not wasn't the best analysis I've seen. So that would kind of be my short take on that. The other thing I wanted to talk about, so long as we're on financial services and infrastructure, I used to be a a shareholder in the Tel Aviv Stock Exchange. Used to, I sold some of my shares earlier, so sold all of my shares earlier this year, and it's been an incredible story, and even now, its results are still completely unbelievable for the most part. Again, it's another. This has been a year where a lot of exchange businesses have done really, really well, um, and there's probably a couple of reasons for that. The durable infrastructure seem to have done really, really well. That's in physical infrastructure, um, and other things like that. So yeah, probably that element of predictability, and then obviously in market environments like the one we're in now, speculation and volumes and markets coming to companies coming to market. Excuse me. This kind of dynamic is in overdrive. In the States and in Asia, there's like a new AI data center supply chain company coming to market every day. Um, and it's super hyped. Even at the end of last year, there were a lot of these crypto infrastructure type businesses that were just coming to market like three a day. That's rolled into the broader technology narrative. There's a whole ETF complex being built up around memory and chips, and the whole dynamic is just kind of going bananas. And then you've got the development of you know uh, risk markets and like Kalshi and other other prediction markets of this variety, and your trading volumes going up almost everywhere, and so we're in like a very hot transaction environment. And so this is one of the places of good organic growth, which appears to be secular. And these guys have been like a tremendous beneficiary of this, along with some other things. So I've talked about it on the channel before, um, and I've written about it ad nauseum. But it was kind of it's a typical demutualization. It used to be owned by a bunch of sleepy banks. The government passed a bunch of economic reforms in 2017, and they decided to get it into public markets and get it into private ownership. And it very much differs from virtually any other stock exchange type business that I've ever seen, exempting maybe like the ASX, funnily enough. But it is like an end-to-end, one-stop financial infrastructure shop in TradFi land. So they've obviously got the main equity exchange business, and get to charge nice recurring revenues for listings on there, and you get to charge one-off fees for listing. But they, on top of that, they also do their own clearings and AUM business. So the more people who transact and bring money into the Israeli market, they get a clip of that. They get a clip of those assets, and then these guys are also the main forum for Israeli sovereign debt to be traded, Israeli corporate debt to be traded. They've opened up cryptocurrency products. There's been talk for many years now about a residential mortgage-backed security market that they would facilitate. They facilitate, derivatives. So they do options, they do futures, foreign exchange. They are the main forum for foreign exchange for the Israeli shekel. And so it's that's to say nothing of the fact that they own the predominant local index IP. So the TASE 50, the TASE 25, And they obviously facilitate trading in those futures products on the indexes, as well as licensing those um, indices to people who are running mutual funds. So there's a big mutual fund business as well. So all these long-standing traditional, like in the United States, for example, this all these products that I've mentioned are dealt with by, even now, even after a lot of consolidation, maybe 7 or 8 different companies. Even in Australia, bank bills are traded. They're not traded on the index. They're traded kind of dealer to dealer. In the United States is the most extreme example, but you've got things like TradeWeb and the New York Stock Exchange and the CME and the CBOE, and part of the thing is simply that in the West, or specifically America, a lot of these innovations were originally made, and then in the emerging Western the Western liberal democracies, you can just kind of copy and paste, right? And you can just put it all under one roof, and so that it's like an accident of history that it's kind of panned out like this. And so, you demutualize, you're allowed to raise prices, you're allowed to rationalize your products, you're allowed to charge for things that you would not, you wouldn't charge for in the past. So like OTC, they run like an OTC board, which is not so different from OTCM in the States. And you can charge transactions on that. You can raise the prices for your clearing fees and so on. You can raise prices for what you charge for the TASE indices, and you can start marketing to brokers, and you can start lobbying the government to put more of the civil services retirement assets into domestic equities, because why wouldn't you? And then when the government needs to raise financing, you can be the major forum for that, and so on. And so it's an unbelievable asset. And the management team was very good, well incentivized, and smart Western investors held a lot of the shares. So they weren't, the government there was not, they did not want to stop foreigners from making money on this, and nor did they want to stop TASE from properly rationalizing the infrastructure. And so you just had this incredible run, and then obviously after the 2023 war kind of concluded, although it's sort of firing up again, volumes and foreign assets started to pour back into the country. And that sort of hit a time where there's been a very hot listing environment. And so that's all guns blazing. And so it's one of these few, and one of the other things I want to say, which is unbelievable, is that they've really kept expenses very mild. You would assume a company that is growing its top line revenue 40% a year at the moment would have some associated costs, involved with that. You would assume you would incur additional operating expenses to facilitate this growth, but no, they haven't at all. They've kept their staff levels about the same, and in fact, the year-on-year expenses for this quarter were down. So it's all been incremental. It's like one of the, for people who pursue this style of investing, which is great assets, which are have their margins go up and that return a lot of money and that grow nicely and that are like growth royalties. This has been by far maybe the most outstanding example that I've ever seen. And this quarter, EBITDA was up 100% year over year, which is remarkable. They're still able, because their products were so modestly priced, they're still pushing through very regular price increases for clearing and in some of their indice products. And then there are just enormous volumes coming to equities. Well, I don't want to critique them at all. A lot of these things are, the TASE has been through an environment like this before in 2020 and in 2021. Now, they didn't have the range of necessarily the range of products, and certainly they didn't have as many companies coming to market, but they did have a very hot transaction environment, and their growth was very steady throughout that period. And then thereafter, when the sort of 22, bear market began to hit, volume sort of started to go in reverse. And then certainly when the war broke out, many foreign assets began fleeing the country for whatever reason. And so, this growth is outstanding. It's, well deserved. A lot of, there's a lot of pricing involved in there, but it probably can't keep going forever at this rate. If they keep growing their revenues 40% a year, I would be suspicious of that, especially as they were, guiding to like 12 or 15%, top line revenue growth, only a couple of years ago, and now it's like, five times that or something like that. And certainly what they were guiding to EBITDA growth was not even anywhere close to what they're hitting now. I don't think any company's ever guided towards triple digit EBITDA growth over, 8 quarters or something like that. Um, and so yeah, that's kind of, some of the reasons why I decided to take some chips off the table in this regard. But an absolutely fabulous company, and I'd recommend studying it to everyone. This is like, and again, you didn't have to participate in like memory or any of these secular, supply choked up, parts of the economy. It's a pure growth royalty, of the purest kind. And again, so much of the growth was translated into profit growth, and then all that money was returned to shareholders in buybacks and in dividends. And it's like, can I find nine more of these? Anywho, that's a bit of a wrap up of financial services this week. Thanks for joining me. We'll chat again next week.